Mode.
Hello everyone, thank you for joining us for another webinar here with iPlanGroup and Self-Directed IRA Insider Series here. And my name is Tim Dobronsky. For those of you that don't know me, I'm the Vice President and the Senior IRA Asset Strategist here over at iPlanGroup. And today I am very happy and excited to introduce to you our guest for the day, who is Scott Estill, who is a CPA and attorney, former IRS senior trial attorney actually, and he's out there in Denver, Colorado, which is a beautiful country out there, and I'm sure it's getting nice and cold out there this time of year, but beautiful. And Scott is kind enough to join us today. He's a guest speaker before on CNN, Fox, NBC, ABC, CBS, Voice of America, Talk America Radio, and he's an expert in not only self-directed IRAs, but also real estate taxes and tax law. So it's really a great fit for our audience here and our clients here at iPlan, because a lot of our clients are investing currently in real estate with their IRAs. And Scott has also written several books, as you can see. He's done the Real Estate Investors Tax Edge, Tax This, which is in its 9th edition, Tax Compliance Guide for Small Businesses, and also a Tax Deduction Business Kit. So well-versed. Again, I want to just thank you, Scott, for taking the time out of your day to join us here and hopefully educate us all on unrelated business income taxes, what I believe you're going to talk about, and how it relates to IRAs and retirement accounts.
Well, thank you very much, Tim. It's my pleasure to be here today on this webinar, and I'll try to keep our webinar as devoid of tax ease as I possibly can. I'll try to speak in as much English as I can here,
okay.
as this is a very, very complicated area. But so I'll try to be respectful of everybody's time and keep our webinar here to about 30 minutes or so, and we'll certainly have some time for some questions at the end here. But what I wanted to do today was to go over this UBTI, or sometimes you'll see it as UBIT, basically the same thing either way as far as what we're looking at. But we're looking at unrelated business taxable income, or if you see the UBIT, you'll see the unrelated business income tax or whatever. But again, we're dealing with the same issue here, and that is that it is possible for somebody to have a tax-qualified entity. In this case, it's an IRA, but this certainly applies to a nonprofit as well. So if we have a charitable organization or something, they can also get into this UBIT or UBTI issue. And what exactly is it that we're talking about? Well, the first thing is that, as the second bullet point here shows, it only applies, this tax only applies to any net business profits, with the key word there being net, not gross. And it also does not apply to passive investment income. So I think we want to start with taking a look at what is this UBTI, why do we have it, and what does it apply to, and maybe more importantly, what does it not apply to? So if we start with the passive investment income, we're talking about income here that you're not going out and earning. You're not rolling up your sleeves and working for it, but instead you're putting money into some particular investment, and you're getting a return on that investment, whether that investment return may be interest. So notice there the first bullet point, interest received from loans made. That's passive investment income, and that's not going to be subject to this UBTI issue. Capital gains, same thing. I buy Microsoft stock today, sell it 2 years later, and get a $5 per share capital gain. That also is passive investment income. Same thing on dividend income. If Microsoft pays dividends during the several years that I own the stock, that is going to be passive investment as well. Rental income on here. Now notice it says rental income, but we're not talking about debt or leveraged real estate here, and I'm going to get into the rental part in a few slides. So let's hold this thought. But in general, if I have $100,000 in my IRA and I take that $100,000 of cash, go buy a rental property for $100,000, so there's no borrowing going on here, no loans with it, and I make, let's say, $1,000 a month on that rental income, that is all going to be passive because I don't have any debt here. Gains from the purchase and sale of precious metals. So I buy some gold or silver, let's say today, a couple years down the road I sell it. Passive investment, no UBTI. And basically we're looking at any other investment type of an option where we've got passive activities going on, meaning we're putting money out there and we're letting the money work for us as opposed to using our energy or our efforts to make it work. So if we know that the passive investment income does not trigger the UBTI, then the next question, I suppose, is, well, what does trigger it? When does it apply? And as this slide shows, when an IRA earns a net profit, and again, we're talking net profit, not a loss here. So even if your IRA took in $100,000, it doesn't mean that there was a profit here. Maybe it was all expensed out, and therefore there's no net profit for this tax to hit on. But when we do have a net profit from an operating business that has not otherwise paid income tax, those profits will then become taxable. So when does this really kick in? Well, it kicks in when we have our IRA, in this case, operating some sort of a trade or business. And we're doing this regularly. It's not just a one-day type of an event, but it's an operating business carried on regularly, and the business activity is not substantially related to the exempt status. And what does that mean in an IRA? Well, the IRA is set up as a retirement account for investments. And so if we're talking about money coming in that's not an investment, or to go back to the last slide, the passive investments, if it's not that and we're operating a business, then this UBTI is going to apply. And before I move on, one of the questions that I get quite a bit, and maybe we'll get it on this one, but one of the questions I get is, why do we have this? Why do we have this UBTI? Why does my IRA have to pay taxes here? And basically what we're talking about is leveling the playing field. And let me just arbitrarily pick an example here. I'll pick a gas station or let's say a convenience store or something that we're going to operate. And I'm going to do that as my career. So I go out today and I set up a corporation or an LLC or some business entity. I go buy the gas station, the convenience store, and I start operating it. And at the end of the year, I've got $100,000 profit. I am going to pay tax on that $100,000 depending on how I have my business set up, either at the business level or on my personal return. So there's clearly going to be a tax on my profit because it's a business profit and taxable under the current Internal Revenue Code. Now let's take that same situation, and instead of me operating the gas station convenience store, I'm going to have a church or a hospital or some other nonprofit operate that. They can do the exact same thing as I'm doing, but at the end of the year, even though we have the exact same businesses, I have to pay a tax on it, but the church or hospital does not. And basically it's a fairness issue that there's no way that we can compete with a for-profit business against a nonprofit business when we have to pay taxes and they don't. So this UBTI has been around a long time, and it basically levels the playing field so that if I'm paying taxes on my business as a for-profit business, then so will a nonprofit. And this applies to an IRA. So instead of having a church or a hospital or some other nonprofit in there, we now throw in the IRA and say the IRA is going to operate this gas station convenience store. Again, not fair to me operating this in a taxable corporation. So to level the playing field, we have this UBTI. And I think if we think about it in that way, it makes sense. But like all other tax provisions or other tax returns or other tax issues that we have, there's a lot of planning that goes on here. And we have to do tax planning if we're going to be hit with this UBTI. So when does it apply? Well, we know if we're operating a trade or business in our IRA that it is going to apply, it meaning the UBTI. So what do? Well, the first thing we do is we take a look at and we see how much income we made. So we go to the business that's being operated in the IRA and we run all the numbers, and let's say it came out to $100,000 of income. So we know we have a potential UBTI here because we have a trade or business, we're operating it in our IRA, it's not substantially related to the exempt status, so we're kind of stuck here that we're going to have tax on this $100,000. So now we have to look at the tax planning part. And our first bullet point says, claim all ordinary and necessary expenses against gross rental income. And that can be gross business income as well. So what we're looking at here is any expenses that it took us to incur this or to gain this $100,000 of income now become tax deductible expenses. So any travel, any meals, any supplies, any inventory, office rent, anything that we have that a quote-unquote normal business would be using or expending money on, we can use as well for this. And our goal here is to take all of our operating expenses, including any interest that we're paying on any loans or any debt that we have related to the business, and depreciation. And the depreciation one is huge when we're looking at rental properties. Certainly becomes an issue when we're looking at businesses as well. If our gas station that we're operating needed a new cash register, a new computer system, or new lighting fixtures, or something that may need to be depreciated, we want to be able to book all those expenses. Because our goal here is to bring down the income to as low as possible, using $1,000 as our threshold, knowing that if we can get our net income under $1,000, there's no UBTI. We don't even have to worry about paying it. If it's over the $1,000, we do have to pay taxes on it, and obviously the lower the amount of taxes that we're going to pay. So we've got to get our income down. And I'll show you in a later slide here what the tax rates are, but they can be very, very high. So we want to make sure that, again, if we're in this situation where we've run the numbers, it makes sense to do this in our self-directed IRA, and there's many instances where that is the case, then we want to make sure that now that we're going to go forward with this plan, that any taxes we pay are to the absolute minimum, that we're not going to overpay our taxes because we miss business expenses or we miss operating expenses or we forget depreciation. So we want to make sure that we grab all of these expenses to get to the bottom line. Now, third bullet point here, use of a business entity such as an LLC or corporation will not avoid the UBTI. So that what that means here is that you certainly can use an LLC or a corporation to run the business, and from an asset protection standpoint or from good business planning, we would likely recommend that. But simply having an LLC out there in no way says that we don't have to pay UBTI. So the entity itself, no reflection on whether UBTI is owed or not. If you're operating a business in an IRA and it generates income after expenses of more than $1,000, you will owe UBTI. Okay, and so when I say you, I'm actually referring, though, as the fourth bullet point says, to the IRA itself. So in this case, let's go back to the gas station. I operate this in my IRA. I take in $100,000 of income. Going through my expenses, I come out with $95,000 of expenses. So the net income is $5,000. Looking at that, it's more than $1,000, so I know that UBTI is going to be owed here. So what will happen? Well, the IRA itself will file its own tax return. That's this Form 990T, and any taxes that are owed on that $5,000 or whatever the net profit happens to be during the year, those taxes are paid by the IRA. So you as the IRA owner or the beneficiary of the IRA, you do not pay the taxes. The IRA itself will pay that tax. The last bullet point I think is important here because we have people that not quite as common running businesses in their IRA, although I certainly see that, but rental properties with debt. So somebody goes out and leverages a rental property. A lot of times those particular rental properties, especially in the early years, will have a tax loss. And so the UBTI is not owed here because typically the depreciation is sufficient that it'll more than offset any income, depending on how much is financed and the deductions for the interest as well and the taxes that are paid. But the big thing on the last bullet point is that what if we do have a loss for the year? We can still take those losses and build them up every year. So let's say in the first 5 years, each year generated a $2,000 tax loss. So we know that we didn't have a net profit, we don't have to file this Form 990T, and we have these losses. 5 years of losses, $2,000 a year, gives us $10,000 of losses to carry forward. Let's say in year number 6, after we took all of our expenses, we had an actual $10,000 profit. Normally that would generate the UBTI, but since our loss is carrying forward our $10,000, that would eat it up and we wouldn't owe any tax. So it's real important to understand what kind of losses we have going forward so that we can use those to plan for the future when we do have some profits. So if we're looking, I think as far as the UBTI goes and the real estate issue, and this is real big because you're also going to see what's called UDFI. And so same exactly initials here except for the T turns to an F, and instead of unrelated business taxable income related to unrelated debt financed income. And so what we're looking at is this situation where the first bullet point on real estate. So I have a brand new IRA, I'm self-directing it, and I'm getting away from the stock market and I'm going to buy real estate. I only have $25,000 in my IRA right now that I'm going to self-direct, and I want to buy a $100,000 house. So what am I going to do? Go out, if I close on the house, I put $25,000 down, and I've got to leverage $75,000. Now the big point here in the red on this slide, the non-recourse mortgage, is real big. In a normal situation where you go out and you buy your personal residence, and this varies state by state, but in most states they are what's called recourse mortgages, meaning that if you're the lender and it's my personal residence and I don't pay, in other words, I don't pay the monthly mortgage, at some point there you as the lender can foreclose and you can go after the property. Let's say that you do that and you sell the property and you still don't pay off the mortgage. In other words, the property sells for less than the value of the mortgage or what's still owed on the mortgage. At that point then the lender can come after me personally for the difference, or what's called a deficiency judgment. In an IRA situation, we don't have recourse mortgages, we have non-recourse mortgage, meaning that in a foreclosure situation the only thing the lender can do is go after the property. So if there is this deficiency afterwards, they can't come after me as the IRA owner. So we're looking at an IRA purchase of real estate using non-recourse mortgage. The debt finance portion of the property's net profits is subject to UBTI. So what does that mean? A lot of lingo here and not very clear, but if we're looking at my situation where $75,000 is financed, $25,000 comes from the IRA, the debt finance portion there is 75%. So if we had a situation where, let's say we had a $10,000 profit after expenses, no losses to use, so we just have this profit of $10,000 on our rental, 75% of that would be taxable. So we'd have a tax on $7,500 for the UBTI. And the same thing here on the capital gains, the second bullet point. same exact situation where the property is 75% leveraged. Let's say that the IRA now sells the real estate. It's still debt financed. So then we have to look at what's the capital gain that we have, and in this case we would take 75% of that, or whatever the amount is that's financed, and that would be taxable. So we have to look at anytime we're using debt or leverage in our IRA, we have this potential debt-related finance income that's going to be part of this UBTI, and we need to plan for it. We need to look at how much money we're putting in relative to how much money the lender is putting in, kind of the ratio between our equity and debt in the particular rental property. But we've got to be able to understand what ramifications this is going to have if we're going to use leverage. Now, for a lot of folks and a lot of the clients that I see that are doing this, if the leverage is high enough, in other words, if you, let's say you can get a 75 or 80% loan to value loan here, your interest payments on that, coupled with the depreciation, is almost certainly going to knock out any UBTI. And where the problem comes in is after the property has been owned for several years, we start seeing now that more of the proceeds every month that you're paying on the loan is going to principal and not to the interest. And so every year that the interest is going down, and assuming our rents are going up over time, our net profit then is going to be swayed into the profitable side as opposed to the loss side. So if you hold the property long enough, pretty much with any sort of debt, this UBTI is going to apply, and we just want to plan for it. I've seen a lot of different situations. I've been at different live seminars around the country where people will talk about never using any debt in an IRA. If you're going to self-direct the IRA and you're going to use real estate, don't use any sort of financing because of UBTI. And when I hear that, I just want to shake my head, because that's not, in my opinion, the right answer. The right answer here is that if you're going to use debt in your IRA to finance real estate or some other investment type issue, we need to understand how that debt is going to work. How is it going to be taxed? Is it going to be taxed? Is it going to generate a UBTI issue? How can we plan for it if it does? So in my opinion, instead of just stopping and saying we don't want to use any financing in an IRA, instead we ought to take the next step and say, if I use financing in an IRA, what impact does it have? And you may find that it doesn't impact you much or at all. You may also find that it impacts you quite a bit, and we want to do some planning. Either maybe don't do this investment in your IRA, maybe we switch the amount of debt to equity that we have, maybe we look at some expenses and we try to zero it out. In other words, it may be a good investment, and we just need to do some tax planning here to gain the benefits of the IRA. So we may want the tax deferral, or if it's a Roth IRA, the tax-free nature of the gains here. And I don't think we want to just dismiss this simply because we have the potential to generate this UBTI, this additional tax. So let's keep that in mind as well, that it's a planning opportunity here, and it may be one that tells you we don't want to do this at all, but it may also tell you we want to do it, we just want to understand what the rules are, what the ramifications are for actually doing this. And I think a lot of the tax stuff, it kind of relates to this cartoon that's up here, is that there is just a lot of fear with the IRS, there's a lot of disinformation, misinformation, and you need to understand for your particular tax situation what is right for you. What can you do? What can't you do? What should you do? What things should you be looking at? Where do we want to go with this? And I think as long as we understand what it is that we're trying to do, there's no reason that we can't do real estate in an IRA. There's no reason that we can't do this. And so we want to look at it. And if we buy real estate and we're holding it long term, meaning we're going to rent it out or hold it as an investment type property, and we're not financing it at all, so the IRA paid 100% of the purchase price, we don't have to worry about this UBTI. But the UBTI can apply in the two real common situations for an IRA owner. Number one, we have debt on the real estate itself within the IRA, and so we'll talk about that. Second one is that we're doing real estate activities as a business in our IRA. So not do we have a debt issue, with the leverage, but what we have here is a business activity and what's called a real estate dealer. So we'll talk about both of these situations because these are by far the two most common situations that my law firm sees when we're dealing with a lot of our clients self-directing IRAs and using real estate in there. So the first one we look at, and here's this debt-financed income that I was talking about here. So we're talking about a tax resulting from an IRA using a mortgage to purchase real estate. We're only taxed on the percentage of the net income attributable to the leverage portion of the investment. So what does that mean? Well, first of all, bullet point number one says we have to have a mortgage. So if we don't have a mortgage, we can scrap this slide and we don't have to worry about it. But if we do have a mortgage, and now we have to take the ratio. In the example that I used before, it was 75% mortgage, 25% down payment here. So in that case, we know that 75% is our leverage portion, and then we have to take the net income of that and then use 75%. Now obviously that 75% could be 90%, it could be 10%, it could be anything depending on how much you leveraged here. And so we want to be sure that we understand anytime we're using debt in our real estate purchases within an IRA that it has the potential to generate this tax bill if we don't do any planning. So we want to be sure that we plan for something like this. And the second one that I had up here just a couple minutes ago here was the real estate dealer. So our first one is I'm buying real estate, I'm using leverage in there with a mortgage, and so I have this potential UBTI issue. The second one is I'm doing real estate as a business, not as an investment, and so therefore the real estate dealer issue comes up. And if I am a real estate dealer, then all of the flipping activity that I do in my IRA is potentially subject to this UBTI, and so we have to be aware of this. So what is a real estate dealer? Well, the last bullet point looks at our classic case as a fix and flipper, somebody that's not buying real estate as an investment. So if we have a situation where I use my IRA, I go out, I buy a property today, and I'm going to sit on it for 5 or 10 years and either rent it out or just sit on it. Maybe it's vacant land, or maybe it's just a vacant building or whatever. But I'm deciding that it's a pure investment play here. I'm going to hold it and I'm going to sell it for the capital gains. That's not a real estate dealer, and we don't have to worry about that. But what we are looking at is people who are using real estate as their inventory. So the example, kind of the analogy I use is when you go in the grocery store and you see all the cans of soup there, that's the inventory. And basically for the grocery store, the more often they can replace that inventory, the better for them. So they want to flip their inventory of cans of soup as many times as they can during the year. And the more times they do it, presumably the more profit that they'll make. And the same thing with the real estate taxpayer here in the flipper situation. The more times I can flip properties, the better for me. So if I can buy a property today, renovate it tomorrow, list it the next day, close on it the following day, and obviously I'm using some very unreasonable or unrealistic time frames, but the point here is that I want a very short holding period. And so my profits then, so let's say I can do this in a 30 or 60-day flip, my profits then can be used for the next flip and the next one and the next one. And so what does the IRS look at in these situations? They're going to look at what's called a facts and circumstances test, going back to what was your intent at the time of the purchase. So was your intention to basically to take this property and fix it up and immediately flip it, or was your intention to buy it and hold it long term, or maybe something in between? So when we look at the facts and circumstances test, the courts and the IRS, if this is an audit issue, will look at your intention along with how many sales did you do during the year. Did you do 1 or 2? Did you do 100? Did you do 50? Did you do 3? What did you do? Obviously, the more sales you do, the more likely it is that you're a dealer. Holding period is real big in the sense that if you're holding these properties for a month or 2 and selling them, it's going to be real hard for you to make the argument that your intention wasn't to flip them. It would look like from your holding period and the number, maybe the number of sales you did, that your intention was absolutely to flip them, and you're going to be a dealer at that point. What extent of improvements did you do? How much time and effort are you spending on this? How much money are you making? Was there ever an attempt to rent the property, or did you just immediately throw it into the MLS and try to sell it? That's a real big one there. And so there can be situations where you're going to try to rent the property and you ultimately sell it, but your intention was to rent it. And so the intention here is real big on exactly what did you do with the property from the minute you put your offer into the property to the minute you closed and took title to whatever you did while you owned it to what did you do when you sold it, how long did you own it. And when I'm saying you here, I'm really referring to the IRA, as that's really the owner here. So the dealer issue is always going to be problematic because we're dealing with a very uncertain test. We're looking at this facts and circumstances, which you could have 10 people looking at the same facts and circumstances and come out to 10 different answers here. Yes, this person's a dealer. No, they're not. But my advice here is we don't typically want to mess around with our IRAs and getting real aggressive on the taxes there. So if you are a dealer, or we think that a reasonable person, a judge in this case, would find that you are, or the IRA in this case is a dealer, then we need to know about that going in so we can do some tax planning to try to limit or minimize the taxes that are owed on the UBTI. So the facts and circumstances test becomes real important for the dealer, and in many situations, many IRAs are going to be in this position where they're going to have UBTI because they are flipping properties, they're a dealer, or because they're using leverage, or maybe both. And so you may be running this business, and we need to be aware of it. So what do we do if we have this UBTI? Well, we know that the UBTI applies when the net income, the net profit, is in excess of $1,000. We have to file the 990T. It's due on tax day here, and you can get an extension. So be thinking about if this is an issue here, we want to get the return filed on time, or at least get it timely extended here, so don't blow the April 15th deadline. But given the tax rates are being very high, I think the fourth bullet point becomes real important here, and that is that there should be some financial analysis done between two different investments here. One, doing it within the self-directed IRA, and two, doing the same investment in a currently taxable account. So let's say that I'm going to flip 5 properties and I've determined that I'm going to be a dealer. What happens if I flip those 5 properties in, let's say, a corporation that is going to end up on my personal return? In other words, an IRA is not involved. What happens to that as far as the taxes go? And calculate that. Now let's take the same flips and put them in the IRA, calculate the UBTI, and let's look at the difference between the two. What kind of financial analysis is there to show that if we do this in the IRA, it's much better, or it's much worse, or it's about the same as doing it in a taxable account? And the reason I think that the analysis is real big is 2 reasons. One, we may want to avoid this UBTI, but 2, we may find out that it may be better to do it in a currently taxable account, or it may be better to do it in the IRA even with the UBTI. And the real big problem with doing it in the IRA, if we start looking at the UBTI, is that the top tax bracket is hit at a very, very low amount. So on this particular screen, you see the 5 different tax brackets here, and these are the same brackets for individuals. While there's a 10% bracket, there's also 15, 25, 28, 33, and 35. These are the current brackets. These will change on January 1st without any congressional changes in place. So understand that this slide will be changing slightly here depending on what Congress does for the 2013 tax year. But notice that for individuals, the 35% bracket, if you file married filing joint, is reached at somewhere in the high 300,000 range. I want to say the number's in the 380,000 range before you hit the 35% bracket. Notice for an IRA, that number is reached at this very small 11,650 number. So we're going to reach this amount much quicker. So the planning, in my opinion, becomes much more important than maybe just even a regular business activity, which clearly has tax planning needs as well. But here, given our rates are so high so quick, we want to make sure that what we're doing is going to come out in a tax advantageous or a tax wise way. So keep these amounts in mind as far as the rates go for the IRAs. Also understand too that these are the ordinary income rates, and that if we do have capital gains in the IRA, and this would be because we have leveraged property and we have this UBTI, that the capital gains rates, the long-term rates, do apply. So if you do hold a property for more than a year, the long-term capital gain rate of 15% would still apply. So it's not all terrible here, but we want to understand that the tax bills can be high very quick, and without planning, you could see that you could end up in a really, really poor tax situation just simply because you have this UBTI in your IRA and you didn't do any planning with respect to it. So that's real key to understand the planning. And how do you get this planning? Well, I've thrown up here Pub 590 from the IRS. You go to irs.gov and punch in the Pub 590. You'll pull it up. You can either order it and they'll send it to you, or you can pull down a PDF and print it out right online. My opinion is, given it's free, given it does contain what I think is very, very good information here, that if you are self-directing an IRA, you should get a copy of this publication. Even if you don't think that UBTI is going to apply for you, you know that you're not going to be flipping properties, and you're never going to have leverage in your IRA, you're not going to be running a business in your IRA, so you don't think that this UBTI stuff is going to apply. There's a lot of information in Publication 590 that may apply to you. Self-dealing issues, prohibited transactions, required minimum distributions, all kinds of good information that applies whether you self-direct the IRA or whether you have a traditional IRA through Fidelity or some other mutual fund company. But most of my clients are self-directing their IRAs. They like the flexibility. They like the control. They like the fact that they have a lot more investment options available to them. And I think just reviewing this Publication 590 is a good overall plan to it, so that you don't end up with a tax plan like this cartoon here that I have up on the screen, where it talks about putting all your earnings in box 1 and then send a check for the amount in box 1. In other words, hey, whatever you make, let's do 100% tax on it. And for myself, and I know a lot of my clients, that's the way the tax law feels sometimes, that we are just turning around and giving all of our money to the IRS. And without planning, that's going to be certainly more true than false in a lot of cases. And when we're seeing very high tax rates, and we're looking at potential high 30s in the income taxes, we've got employment taxes that can be another 15%. We can have another 10% going to California or Illinois or some other state that you happen to live in. And when you add all that up, it can be over 50% of your income. So we want to be aware of what are the tax implications to this. What can we do to avoid some of the UBTI, and how can we plan for any taxes that we may owe? And this is something that my firm has been doing, certainly not just on the IRA side, but on the entire tax planning side for businesses, for individuals, for IRAs. And so we do help out a lot of people that are looking at doing some planning, that aren't happy with their current tax situation. Maybe they don't like their tax preparer, or they're not getting good tax advice. There's no planning going on. We have an audit coming up, or we owe the IRS some money. All this stuff is what my firm does. So I'm going to put my contact information up there, and I know that we have some questions, and I'm going to get back to Tim here so he can go through some of the questions that we have. And I know we can't get to all of them, but you've got my website up there, telephone information, so if you need to contact me, by all means do so. But I'm going to close here before I get to the questions with just a couple of quick facts here to remind us of some of the things that we went over today, and that is that using a business entity will not protect you from UBTI. So if you have an LLC or a corporation, it may be a very good idea to have that corporation in place or LLC, but you're still going to owe the UBTI. If it's owed, the IRA will pay it, not you. So you do not pay the UBTI, the IRA does, and it's based upon the IRA's own tax return. So whatever the IRA is doing with its taxes will not affect you or any of your other businesses or your Form 1040 or other personal tax filing. Notice too that we get these losses carrying forward on real estate. So if we anticipate paying it in the future, we may want to have these returns, these 990Ts filed, and we do those returns, so we can help you do those as well. But notice with the leverage and the depreciation and the interest that typically we're talking about 4, 5, 6 years out of owning the real estate before the UBTI becomes something we got to look at. That's not to suggest, though, that we don't look at it up front. It's just normally this hits in around 5 years or so, but we want to look at it up front. So anyways, I'm going to stop here with that and see if we do have any questions, and we'll just take it from there.
Well, great. Yeah, that was great information, Scott. I really appreciate it. Again, you coming on and educating all of us. I mean, there's always, pick up usually a thing or two at least, and I know I learned a few things there in your presentation so that I didn't know. So I really appreciate it, Scott. And we do have a couple of questions. We're going to, like you said, we can't get to all of them today, but we're going to try to knock out a couple of these right now, and hopefully answers some of your questions. And then if you have more questions, please feel free to contact Scott there at his office or iPlanGroup here at our office, and we'd be happy to answer any other questions you have. Looks like John here had a question on whether or not the mere presence of an IRA-owned LLC triggers UBIT or UBTI, or is it the operational activities of the LLC that really determines the UBTI?
Oh, okay. That's a good question. So simply having an LLC will not trigger the UBTI. It depends on what that LLC is doing. And so I have quite a few clients, I meant to say here, quite a few clients that, let's say, will set up an LLC in their self-directed IRA, and then that LLC will start directing the investment. So maybe it'll buy a few shares of stock or some other quote-unquote traditional type IRA investment, and then it'll also do something else that may be a little bit more out in left field as far as the investments go, just to give you some variation on the investments themselves. And you have to look at what the LLC is doing. So just having that doesn't mean that we now have a business and now anything we do is going to be subject to UBTI. So good question there, John.
Okay, great. All right, well, another one here from Steve. He wants to know what a conservative number of flips per year that he could do with his IRA funds without being considered a dealer. Is there, I know you used to work for the IRS, so, that's the nice thing about, having you here kind of on our side is, what's a conservative number do you think that they would be looking at as far as the number of flips per year in your IRA?
Yeah, that's something that we as tax professionals, we've been asking for that for quite a while, because you go to, I've been to some events, live events, and the speaker will be saying, well, if you do 3 flips, you're okay, but if you do 4, you're not. Or they come up with these numbers, and unfortunately there is no number that is going to trigger the dealer status. So it's possible that you could do 2, 3, 4 flips and be a dealer. It's also possible you could do 5 or 6 flips and not be a dealer. It would depend on what your intention was, what your holding period was. So let's say I go out and I buy a half a dozen properties in my IRA, and my intention is to hold them for 10 years. And Tim, you come to me or come to my IRA and say, I want to buy those 6 properties from you. And I say, well, Tim, they're not for sale. And you said, well, you haven't heard my price.
Right.
And and you offer, and let's say I paid $100,000 for those 6 properties, and you offer me $500,000 for it. And I'm going, well, those aren't for sale, but for $500,000, they're for sale, and we do the deal. Yeah. Right? So I just flipped 6 properties in 2 months, and I am absolutely not a dealer. And you can make that number a lot higher. Let's say I bought 50 or 60 properties from a bank REO list, a bank real estate owned list, and I'm planning on holding those for 5 years, 10 years until the market really comes back, and I'm going to make my retirement on the capital gains. And you come and you again make me a big offer here. I just flipped 50 properties in 1 year, and I'm not a dealer. Okay, again, because of my intention. Now let's flip this around, no pun intended with the flip word there, and say basically here, I'm going to buy only 3 properties this year. I'm going to buy them all in my IRA. I'm going to renovate them all, and I'm going to flip them all, and I do, and I'm successful. Tim, you buy all 3 of them, you like them all, and you do whatever it is you're going to do with these properties. I've only flipped 3 properties this year, and I'm clearly a dealer, whereas the last example, I just flipped 50 properties, and I'm not. Yeah. So you have to look at the intention. So it's a real hard question to answer, but I think you can see that if you can, if you can get in there with the facts and circumstances test and be able to show the IRS that, hey, my real intention was not to flip these properties, but something came along that not necessarily forced me to do it, but definitely encouraged me to do it. And it can be not necessarily always a good thing. My situation with Tim buying the properties was a real good thing because I made a huge amount of money that I wasn't expecting. But let's take it the other way and say that I've got properties in my IRA and they're rental properties. I'm buying them for rent, and now I don't have tenants, or I'm bleeding cash here, and I've got to sell them real quick. So I'm flipping these properties quick, but that was not my intention. Okay, so there's a lot of different ways you could get to this. Sure. But unfortunately, Steve, I think you said that, Tim, wasn't it, Steve?
Yeah, it was Steve. Yeah.
Yeah, Steve. There's not a one size fits all here. Where if you do under this number, you're not a dealer, and if you do over it, you are. You got to look at the specific facts here. Unfortunately.
Yeah. Okay. Yeah, I get that question a lot too, so I'm glad you explained that there. Dennis has kind of a follow-up question to that too, I guess. He said, well, what if my intention is to buy and flip 2 houses per year in his IRA? Would you go ahead and pay the UBIT as a dealer, or would you just wait until the IRS kind of brought it to your attention?
Yeah, that's, it's interesting there, and this is a question that doesn't necessarily apply to IRAs, but just taxes in general. And I think my basic premise on these always is that if the tax law is black and white, then we've got to follow it. If the tax law, if the tax law is gray, which is probably 90% of the tax code, where right. It kind of, maybe we can do this, maybe we can't, or we're not sure, kind of this guesswork that comes into it. Then we can, we can plan and we can take a more aggressive position. Okay. So, on this situation, so I did 2 flips. I go through the test, and I'm not sure if I'm a dealer or not. Mm-hmm. I just don't know, and I can't tell. And so Dennis calls my firm up. I go through it with him, and I frankly can't tell either. You're right in that gray area. Yeah. In that case, I probably wouldn't take it. I wouldn't report it because I'm not even sure that it applies to me. Right. That makes sense. Now, let's take the opposite, and that is that I did a couple flips, and I know that it's black and white that I'm a dealer. In that case, I would always report it and not wait for the IRS. And the reason for that, a couple reasons. One, I think it's the right thing to do. When we're dealing with taxes, we still have ethical issues and we want to do the right thing. It's just that a lot of times we don't know what the right thing is.
Sure.
With taxes. So that's a big problem. But the other thing is that if the IRS brings it to our attention, and it was pretty clear that we are a dealer and we just ignored it, there's penalties that the IRS can hit us with, and they can hit us with negligence, they can hit us with fraud, they can even do some IRA issues where if there's a prohibited transaction or something like that in an IRA, they can deem the whole IRA to be taxable. So it kills our tax planning in the IRA. So
Yeah.
I think we want to be real careful with what we're doing in an IRA, because the IRS penalties can be very severe if it's determined that what we did was wrong and we should have known better.
Okay. Yeah. Yeah, that makes sense. It could go either way, I guess. Really. Okay. Well, that's good. Another good explanation. I appreciate that. Okay. A couple more here real quick before we end this call and webinar here. Dave wants to know, can his IRA use depreciation to offset UBTI?
Yes, you can. What's with all the men here? Come on, don't we have any women questions?
Yeah, I guess. It looks like well, there's a couple on here. Yeah, there are.
Yeah, as far as that goes, Dave, that's the key planning part, I think, because when you're looking at real estate, the income and the expense side is all pretty straightforward. What did you pay in rent, and how much went out to the lender, and what did you pay for repairs and taxes, and you kind of have a record of all this stuff. But depreciation is a paper expense in the sense that hopefully when you buy real estate, you're buying an asset that's going up in value. But for tax purposes, we're taking it down in value. We're depreciating it. And by using the depreciation, in most cases, certainly not all, but in most cases in an IRA, we can use depreciation with our operating expenses to get the net income down either below zero or certainly below $1,000, so that we don't have to pay the UBTI. So yeah, good question there.
Okay. And because I don't want to discriminate, I've got a question here from Jackie, who wants to know how long do you have to wait to sell a property in your IRA after paying off a non-recourse loan to avoid the UBTI?
Oh, Jackie, you got to give me a technical question here. Typically, when we're looking at debt issues, we're looking at a 12-month window back. So if we sold the property today, we would go back 12 months from today and determine what sort of leverage or debt that we had on it to determine the ratio of how much of the capital gains would be taxable for this UBTI and how much would not be for purposes of the IRA. So it's a 12-month look-back window. So if you pay off the debt today and 12 months later you sell it, we don't even have to deal with this issue. So good question there as far as the planning. And I see people a lot of times they miss this. They'll sell it a few months afterwards, and then had they known that there was this seasoning period, they may have held the property longer just to avoid giving the IRS some of the profits here.
Yeah, definitely. Save that tax money.
Absolutely.
All right, great. Well, a couple more here. Nancy wanted to know, how much does it usually cost to hire someone like you and your firm, there, Scott, to file the 990T for the IRA to pay the UBTI?
Okay, normally those are fairly straightforward returns. We're usually talking $300-400, something in that range on that.
Okay.
If it's one thing that we're putting in there, could be less. If it's got a huge amount of, it's kind of like if we're doing a General Motors type of business within the IRA, you're going to have a 100-page tax return. But most of the time, we're talking about a couple rental properties that we may have some leverage income on, or maybe we have a couple flips that we've got to pay the business tax on that way. But these returns are going to be like any other business return, in that the more records you have, the more expenses you have, the better the result's going to be, and the more, the better job we can do for you. But they're not super expensive tax returns to do.
Okay, good. That's a common question, too, that I get a lot, and I don't know how to answer it, so I'm glad you had that answer. So one last one here from Ryan, and his question was, if his IRA buys a franchise, but his IRA hires a manager to operate that business, will his IRA need to pay the UBTI for operating a business?
Okay, so we're operating a business, and make sure I get the facts right here.
Yeah.
So the franchise is actually being operated within the IRA, or it's
Right.
an investment in the franchise?
Yeah, the IRA it owns and invested into the franchise. It looks like it owns, according to Ryan, owns the franchise. The IRA does, but the
Okay.
IRA then the IRA owner is not involved in operating the business.
Right.
Hires a manager.
Right.
To operate it.
Yes, in that situation, we still would have to file, and we still would have this potential UBTI issue. So in other words, if we go out and let's say my IRA is going to go out and buy a Burger King franchise,
Yeah.
and I hire Tim, who has no relation to me, so he's not my brother or any blood relative of mine. I hire Tim to manage the Burger King, but all the profits are going to go into the IRAs, at the end of the year. That will trigger the UBTI. If it was a situation where my IRA is going to invest in a Burger King, so let's say Tim has a Burger King out there and he's looking for some cash, and my IRA puts in, let's say, 10% of the value of the franchise, but I'm not operating it, I'm not running the business, in that case it would not generate the UBTI. So you have to look at what is being done here, and are you putting the money in as an investor or as a business owner? And if you're owning and operating the franchise, whether you manage it or not, and I definitely would not recommend the IRA owner to manage it.
Right.
You definitely want to have somebody not related in that situation, so we don't have any self-dealing issues, but you will generate the UBTI in that case.
Okay. Very good. All right. Well, that was the final question there. Of course, there's some more here, but I think we're going to wrap it up here. But again, if you do have more questions, feel free to contact Scott over at his firm or iPlanGroup here. We'd be happy to answer any other questions you have about self-directed IRAs, UBTI, and everything else regarding your retirement planning. So again, Scott, I want to thank you for being on the call today, and I want to thank all the attendees. Thanks for all the great questions and joining us today on the webinar. But again, Scott, that was terrific information. I really appreciate it, and hopefully we can do another one soon.
Great. Thank you very much. It was my pleasure.
All right, Scott. Well, you take care. Have a great day.